This here is the most important chart you will see in all of crypto, and I'm surprised that not more people talk about it. It's the stablecoin market cap relative to the US money supply. This used to go sideways since October of last year. Before that, it actually went up, and now recently it's coming down. Why does this matter? It matters because it has a direct impact on crypto prices. When the stablecoin market cap is going up, crypto prices tend to go up. At the bottom, we see Bitcoin. When there's no more inflows into the market, once the inflow stopped, that's when Bitcoin peaked as well. Thus, since now the stablecoin market cap is going down even, that could accelerate the sell-off for Bitcoin. Now, why does the stablecoin market cap matter? It matters because it's a direct reflection of how money enters and exits the system. If we ignore the ETFs, which by the way only hold around 5% of Bitcoin supply, when we look at all the other capital, that's mainly driven to stablecoins. So when you deposit your hard-earned fiat currency to a centralized exchange in order to trade crypto with it, the fiat currency, in the end, through some loops, will go to a stablecoin custodian. That stablecoin custodian will hold your fiat funds in a bank account and then, for those holdings, issue stablecoins on the blockchain. And that issuance we can see in the chart. The same is true the other way around, right? If you are withdrawing from the ecosystem, if you want to get money back into your bank account, then the stablecoins get destroyed. So when there's no more money flowing into the system, of course, prices have a very hard time appreciating. Since October of 2023, the stablecoin market cap tended to rise. And that's when Bitcoin went from 25K all the way to 125K, right? A 5x. The stablecoin market cap during that same time frame appreciated by only 130%. So there is a leverage effect here, right? $1 moving into the system increases the market cap of assets by more than $1. Now, why is that? It's because not all of the supply is liquid, right? Let's say you've got a street with 100 houses and each house is exactly the same. They're all worth, say, $1 million US. Now, nobody wants to buy and sell any of the houses, but let's say a rich family moves in and then decides to buy one of the houses for a higher price. Let's say for 1.1 million. Now, since all of those houses are completely comparable, the market cap has now appreciated by more than just 100K. All those comparable houses get repriced. So now we've got 100 houses that are all worth 100K more. The market cap has increased by 10 million, while only 100K were paid in addition for a single house, or there was trading volume of 1.1 million, right? So there's almost a 10x multiple in this example for trading volume versus market cap change. And so the same kind of leverage effect happens for crypto as well, right? When the stablecoin market cap is going up, when more capital flows into the system, then as a percent, prices tend to appreciate more than that. Now that's good for the bull case, but it's bad for the bear case, right? Because the same kind of leverage also works in the opposing direction, right? Let's say one of the families is now struggling and has to sell their house for 900K instead of 1 million. Suddenly, all of those other houses, because they're completely fungible in this example, they drop in price. We've got 100 houses. We've got only 90 million of market cap. The market cap fell from 110 million to 90 million. Now, we had a shrinking stablecoin market cap before. The situation was actually very comparable, as in we first had our appreciating stablecoin market cap. Then once that flipped around, we already fell in Bitcoin by roughly 50%. But once we had the outflows, we fell by another 50%. Now, I'm not saying that we have to fall by another 50% since the outflow started, which would indicate a Bitcoin price of roughly 30K or so. I'm not saying that history will 100% repeat itself. Still, seeing outflows is not great at all. It's hard for, in our example, the housing market to go up in prices, where at the same time the capital that's available is shrinking, right? If all the families suddenly earn less money or they can save less money, how will asset prices appreciate? Now, there's another very important way to look at stablecoins, and that's not just to look at the entire market cap, but to check how much of the entire crypto ecosystem is actually stablecoins. When this is very high, then people are very scared, and so crypto prices should be low. When this is very low, then people are very much risk on. All the stablecoins are getting deployed into the asset. And so we see the stablecoin dominance at the top, we see the Bitcoin price at the bottom, and of course there is a connection here, right? When many people are deployed, when the stablecoin dominance is low, then crypto prices tend to be high. When the stablecoin dominance is high, crypto prices tend to be low. So there is an inverse correlation here. Now, what's important is that in the prior bear market, the stablecoin dominance peaked out at around 16%. And we are currently not there. We are currently at 13%. Last time, when the stablecoin market cap tended to go down, so that was over here, the dominance actually was relatively stable. But of course, prices continued to fall further. And that's a potential danger. I think that the stablecoin dominance will likely even go above 16%. Because last time it went up by roughly 6 percentage points. This time we are at a higher level. If we go up to say 18 or 19% in stablecoin dominance, I would not be surprised. And of course, since there is negative correlation here, when stablecoin dominance goes to 18 or 19%, that means the Bitcoin price should fall. Now, I don't like any of those outlooks, right? I'm the last person on earth that wants crypto to go down. This is the Bitcoin Strategy channel. I do make quite some income with that as well. If prices go up, that of course benefits me. I have an interest in rising prices, but I want to keep this real over here. I want to be objective. I simply share the data as I see this. And while this might be against my interest short term, I think long term it pays off. The people that have been around here, not just for the last few days, but for the last months, potentially even years, they see that I'm bullish when we are cheap and I'm bearish when we are expensive. I say it the way I see the market. And I might not always be right, but at least I try not to be biased. The problem is that MicroStrategy that pumped up the Bitcoin price has stopped buying. They're even now net sellers. You might have seen the news. They cannot buy through their STRC instrument. They cannot buy through selling common stock. They rather do the opposite now because their common stock is now cheap relative to their Bitcoin holdings. So they're incentivized to sell Bitcoin to buy back their common stock or their STRC for that matter. So MicroStrategy might move from a net buyer to a net seller. And the Bitcoin that's held by the ETFs is also falling. This used to be a major purchasing engine for BTC as well. But since June of this year, this is going down. Let's zoom in a little bit. So the top was on the 8th of June, and now supply is exiting the Bitcoin ETFs. Wall Street turned from a catalyst to push Bitcoin prices up to an engine that's further depressing the price in a bear market. We see that people start to give up on Bitcoin. People are realizing losses even. Usually, when the price goes up, people realize gains, right? The realized market cap change is positive. When we are in a bear market, usually nothing happens, as in people don't necessarily realize their losses. They just keep unrealized losses open and wait for a recovery. But now we actually see people selling into the bear market and giving up on crypto. They are realizing their losses. This here is the realized price over the long term, right? And this tends to go up. When we look at this orange line, it barely goes down. In other words, in a bear market, people simply just wait out the bad times. That's the tendency. But let's zoom in a little bit. We now have loss realization. So the average cost basis of Bitcoin is slowly going down. This is a very weak effect. It has happened in the past as well, but it shows that the confidence in Bitcoin is very weak. And so when the price is going down, there are realized losses and there are unrealized losses. Usually, the average Bitcoin investor had to be in net unrealized losses. They had to see their portfolio on average in the red for an end of the bear market. This here is the net unrealized profit and loss, and currently, believe it or not, the average Bitcoin investor is still in profit. As said, the average cost basis is at $53,000 and we are still above that. But with every bear market in the past, be this Mt. Gox and Silk Road, be this the ICO bubble bust, be this COVID or FTX and Terra Luna and Three Arrows Capital, every single bear market had a major systemic blow up And it also had the market in aggregate moving into net unrealized losses. And we are not there yet. So I don't think this bear market is over. Money is exiting the system, and it did not exit the system just 1 month ago. We were just neutral on the stablecoin market cap. Now, don't get me wrong. I do believe in the long term of Bitcoin. Bitcoin supply still expands much slower than fiat currency. So over the long term, Bitcoin will very likely outperform the rest of the market. I also think that Bitcoin is now relatively cheap compared to other risk-on assets, compared to, for example, tech stocks. Tech stocks, I believe, are more overvalued compared to Bitcoin. So Bitcoin could outperform tech stocks, but that's not necessarily because Bitcoin will rally. I think simply that tech stocks have a good chance to decline from here. I think it's better to be on the side of the current momentum. If currently money is flowing out, it's better to be cautious and to buy once prices have stabilized, because that's the difference between bear markets and bull markets. It's very hard to sell the top because usually prices shoot up, are just for a very brief period at those high prices, and then they come down, and then they stay at those lower prices for a long time. In other words, there's really no rush to buy the bottom. Low prices tend to stay low for a while. This was only different during the COVID crash, where we went down by like 50% in the case of just 2 days. A 50% drop in 2 days is a flash crash. There's a lot of forced liquidations. Then it makes sense to buy quickly. But when we are just slowly dripping down, it takes a while for that bad momentum to turn around again. And that means we have our time. We can just dollar cost average into the market slowly. And we can wait with the bigger purchases when we've actually bottomed out and when the market is in net unrealized losses. There's no rush. That's what I try to say. And so if it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. Feel free to also check out the premium membership. That's over here. It's also in the pinned comment down below. There's also a 7-day money back guarantee for premium. In case you don't like it, just message me within the first 7 days and I'll refund you. No questions asked. So see you next time. Cheers.